Hey, Steve Spreski here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or intimate at his videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. Some important updates here. We got the inflation data out of the Bank of Canada, Stats Canada, as well as the national housing figures, which I'm going to walk you guys through so we get a bit better picture as we head into the fall housing market. But first and foremost, a lot of this is going to hinge on inflation. Of course, inflation it looks to appear to have peaked, at least from a rate of change basis. This is something that I've been talking about for the last 2 or 3 months going on, that inflation is going to peak. It's going to peak from a rate of change perspective. That does not necessarily mean that the total level of prices are coming down. It doesn't mean things are necessarily getting cheaper, but what it does mean is that the comps become harder to beat. And so from a rate of change perspective, it's harder to get inflation. It's just mathematics. It's harder to get inflation to surpass the peak. So, the peak was 8.1%. We're now down to 7.6%, and I suspect you could see that come down from 7.6 to 7.2 and vice versa until potentially you get into range of maybe that range lands in 4.5%, 5%. And that's the decision the Bank of Canada is going to have to make, is how deep of a recession are you willing to tolerate with inflation still in the 4 or 5% range. So that's something that we're going to have to wait and see how that plays out. But again, from a rate of change perspective, that's what's important, is inflation is now decelerating. The comps are getting more difficult to navigate. And so you really have to understand how the data is collected, how it's reported, and how to basically interpret it. Because if you don't, then a lot of these headline figures are basically meaningless. Because when we look at Canadian housing, for example, speaking from a rate of change perspective, we had, national housing figures. So for example, house prices, as reported by the Canadian Real Estate Association, were up 10% year over year. So you go, hold on a minute, prices aren't up nationally. No, but from a rate of change perspective, they're up 10% still from last year's levels. But what we can clearly see is, again, they are decelerating. And in fact, national home prices decelerated month over month by 1.7%. So if you start extrapolating a monthly decline of 1.7%, you can start to figure out where we'll be in 12 months from now. And so, in fact, as of right now, national house prices have declined 9.9% since peaking in March. This is actually the single, this matches the size of the housing correction that we saw in 2008, 2009. So again, if you go back historically and look at the home price index across the nation, in 2008, 2009, we recorded a 9% decline peak to trough. So as of right now, this correction is officially as steep, and it will ultimately end up being deeper than the global financial crisis in 2008, 2009. Remember, Canada relatively got out of this thing unscathed, and a lot of that had to do with some of the policies that the government's brought in, which was ultimately forcing the big five Canadian banks, which essentially run the country, to continue to lend money out. And so that's really how we avoided that. And of course, through that, we accumulated more debt and allowed house prices to continue, and the moral hazards that were brought on from that. And that's obviously why I think a portion of the reason why house prices are where they're at today. It certainly encouraged more risky borrowing. And it's the same thing why, when we intervened during the pandemic, which I would argue we certainly needed to some extent, but when people see that house prices don't go down in the worst of times, it encourages speculative behavior and a misallocation of capital. And I think, again, that is partially the reason why house prices remain so elevated, despite the 9.9% correction nationally, or that we've seen. But again, you'll see that these prices are not, these price declines are not, they are not one and the same. In fact, you can see that the bulk of the correction is actually happening in the GTA in Toronto, where house prices from the peak have now corrected just over 13%. You've got Vancouver at 4.5%, Ottawa at 7.4%, Winnipeg 4.8%. And then, of course, you've got markets like Calgary down just 0.7%, which, again, I've talked about. That's been part of my bullish thesis. That market Calgary will, and it is, I can tell you it is going through a partial correction. But the question was always like, hey, if you need to hold real estate as an asset class, if this is something that you're comfortable in, where are more of the vulnerabilities in a higher interest rate environment? And this was always part of the thesis of, okay, Vancouver, Toronto, you can clearly see these are the two growth markets. These are the two highly levered markets that when you get benchmark home prices north of $1 million, that requires a lot more leverage. And so when mortgage rates go from 2% to 5%, you're naturally going to have a steeper correction versus some of these more flatter markets such as Alberta, where there's been very, very little growth. There's very little speculation there. You're running at 5% cap rates in the inner city. There's just less vulnerability there to correct, and then you can throw on obviously oil starting to cushion some of that, and of course higher income. So that's important because we always try to cut through the noise here. At the end of the day, we try to keep our biases and our preconceived notions away from this. And one of those notions is, hey, rates are going up, everybody's going to flood the market with inventory, and this is going to be 2008, 2009, 2.0, and this is going to be the big huge crash that everybody's been waiting for. The one thing that we're not seeing is we're clearly seeing in the data is that new listings are being pulled back off the market. Inventory remains extremely low. So in Vancouver, for example, you say, well, 4.5% correction. Again, that's a little bit understated. We know that there's some of these pockets that are obviously in deeper correction territory, but total inventory for sale is lower than it was at this time last year. New listings as well, lower this year than they were last year. In fact, new listings in Vancouver, as we talked about on last week's show, 20-year low in the month of July. GTA, 10-year low. Where is the inventory? And this is something we talked about. Of the 65% of Canadians that own a home, about half of them don't have a mortgage, very close to half of them. So typically about 1/3 of Canadian households don't officially have a mortgage, and that's on their primary residence. So take that with a grain of salt. There's certainly more embedded leverage than that. We know Canadians are certainly over indebted. But there's a strong cohort of people that are retaining listings from the market. So the question is really, listen, if we get to a scenario where the market can stabilize, maybe mortgage rates go from 5 to 3.5, then that's probably a nothing burger. Now, if rates stay at 5% and you start to see more defaults and maybe eventually slowly listings can accumulate, then you'll see more downwards pressure. But sort of my thesis going forward here is, again, take this with a grain of salt. Nobody's got the crystal ball, but I'm certainly trying to give you guys not only a lot of the data that we're looking at, but anecdotally, what are we hearing, what are we seeing, what are we dealing with clients. We saw this in 2016 in Vancouver when the foreign buyers tax came out. When you have these, and similar to the mortgage stress test, you get these shocks that hit the market, which is, there was a shock when rates went from 2 to 5 in a matter of 3.5 months. That shocks the market. So home buyers basically move to the sidelines and go, I need to see how this is going to play out. There's too much uncertainty. I need to now watch. And that's why you get these little mini flash crashes. Again, we saw this in 2016 where sales basically evaporated for about 3 months before the market was able to slowly resume. And you saw these flash crashes. The people that had to sell during the first 1 to 2 months that the foreign buyers tax was announced, took steep discounts because there was no liquidity. And I think that's kind of what we've seen here in large parts of the market over the last 3 or 4 months, is that there's people that were caught offside, people that still needed to sell because maybe they'd already committed to purchasing something else, or their stage of their life, maybe changing jobs, changing cities, where they had to sell. They had to sell into these illiquid markets during that flash crash shock, and so that's where you're seeing that gap down in pricing. I actually think that the market is probably going to find some level of balance, which is to say that you're not going to have that flash crash, I think, through the back half of the year. I actually think it's going to be more of a slow bleed lower, which is house prices are going to probably, in my opinion, trend lower through the last half of this year, through the remaining half of this year. I think they will trend lower, but it's going to be that slow bleed. I think the market is now, we're starting to see it, the market is slowly adapting to life with mortgage rates at 5% and saying, okay, yes, we want some deals. Yes, we want some better pricing. But I think the days of the flash crash inventory just it's simply too low. We need more inventory to get to market to see another gap down in pricing. And again, that might very well happen. That might be a 2023 story, but it does take time. It takes time to build inventory. So we will have a typical boost in inventory in September, October. That's prime listing season. That's going to add to inventory. But again, it's building inventory off very low bases. And then you'll start to see, again, typically as we see in December, January, those listings again start to recede. Inventory starts to typically decline from a seasonality perspective, and then you'll get back into your spring market. So a lot of this basically hinges on a slow bleed, I think, for the back half of this year. And then 2023 is really the wild card, because the wild card comes down to what is the Bank of Canada willing to do? How far are they willing to push this? You'll keep in mind that just because the inflation data came below expectations at 7.6, the Bank of Canada that same day released an article saying that they were still dead set on fighting inflation, that there was more to come. Again, we are going to have a rate hike September 7th. That is going to push variable rate mortgages higher. I think you get at least 50 basis points, maybe on the high side 75 in September. My view is it's 50 and done for this year, but again, could be wrong. Let's wait and see. Again, this is all going to matter for the housing market moving forward, but what you're seeing is that initial shock again of interest rates, of mortgage rates going from 2 to 5, I think is tapering off. Where you're seeing the cost of 5-year fixed mortgages actually coming down. So we have had some big banks now cutting their 5-year uninsured fixed rates down to about 4.99, so off about 20 basis points roughly. And so that's giving the market at least a little bit of certainty. Again, hovering, knowing that you might just have to digest potentially 5% mortgage rates for the foreseeable future. And again, I think with 5% mortgage rates, that's still too high in some of these highly levered growth markets of Vancouver and Toronto that will likely put more downwards pressure on pricing, and probably less so in these flatter markets, think Alberta, Saskatchewan, etc., where there's a lot less frothiness in those segments of the market. So that's kind of how I'm thinking things through. Another quick note here from my good buddy Rob McClister. I think he's probably the best mortgage expert in Canada. So per his analysis on these trigger rates for these fixed rate, variable rate mortgages, which we've talked about many times on this show, he's got it that in his view, again, there's so much gray area around this. Just I've been chatting with all these big banks, trying to get an idea of their policy measures of how they're going to react. Because again, when the Bank of Canada raises rates in September, there will be a portion of borrowers, more so those that have taken on variable rate products over the last 18 months, I'd say, are going to be potentially, some of them will be triggered, but minimally. And so per Rob McClister, he believes that you should typically see about $125 a month increase in one's payment, $125 increase on one's payment for every $500,000 that has been borrowed. So again, if you've borrowed $1 million mortgage, you should be looking at a monthly payment increase of $250 for every basically 25 basis points over your trigger rate that you are. So again, if the Bank of Canada goes 50 in September, which is the consensus right now, you should be looking at, most will probably be looking at about a trigger rate of 25 basis points. So a marginal increase in their variable rates. And again, that just depends moving forward of how many rate increases you think the Bank of Canada will push from there. Keep in mind that if the BOC goes 50 in September, that brings your overnight rate to 3%. The market is pricing in an overnight rate to end the year 350, so 50 basis points shy. And at 3%, the Bank of Canada will be in their neutral rate. In fact, they're actually already in their neutral rate, which is kind of where they want to be. So let's wait and see. That's kind of what I'm seeing anecdotally on the ground. I think it's going to be a slow bleed for the rest of the year. I think the majority of the flash crash is over for now. Until, do you get more systemic risk in 2023 if rates again stay elevated, and you have some of these private lenders that stop renewing people, other individual borrowers that aren't able to complete on pre-sales because they don't no longer qualify. These are 2023 questions. So for the back half of 2022, I expect things to be a bit more muted, but probably some good deals and probably some good opportunities in the winter this year in 2022. So hope that helped. See you next week.